Well, good morning, everyone. Now we're going to be looking at Chapter 3, Consolidation subsequent to the date of acquisition. So this actually no learning objective 0, but I kind of wanted to give you an idea of consolidation in year 1 because your textbook jumps from Chapter 2, where we had purchased a subsidiary on the last day of the year to subsequent years. So it kind of skips that first year, and I kind of wanted you to understand that first before we move forward. So we're going to use Parrot and Son Company as our example. Parrot Company purchased Son Company on January 1st, 2017. The acquisition or consideration transfer was $800,000 in cash. And we have here some companies' book values and fair market values on the date of acquisition. So we note that trademarks were understated. There's a patent technology that was also understated. And we have equipment that is overstated. Okay, so it's no differences in liabilities or any other current asset or asset. So we have our consideration transfer. We have the book value of some company on January 1st, 2017. We have the differences between fair values and book values for these assets. And we still have a remaining difference, which we're going to call this goodwill. Okay, so goodwill is $80,000. So we take our assets, the under and overvalued assets, and we find the useful life. We find that trademarks has an indefinite life. Of course, goodwill has indefinite life. And so we calculate the amortization or depreciation Since the equipment was overstated, then this amortization or depreciation is actually going to reduce the expense. So the patented technology was understated, we're increasing the expense. The equipment was overstated, we're decreasing the expense to a net $7,000. So we have Parrots. Okay, these journal entries are recorded in Parrot's financial records. So we have the purchase of the investment. So we're going to debit investment in Sun Company. So in this case, Parrot continues to use the equity method to account for this investment. So investment in Sun Company, we debit the 800, credit cash in this case. And then we start recording whatever activity pertains to Sun Company. Again, the dividends and our share of income. Actually, we own 100% of the company, so the entire income generated will be recorded in Parrot's financial records. And then we have the net amount of that amortization. So we're going to debit equity and subsidiary earnings and then credit the investment. So we have our consolidation worksheet. This is for the year ending December 31st, 2017. Note that we're using the equity method, or Parrot is using the equity method to account for this investment. So what we have here is that now we have this equity in subsidiary earnings. Okay, the way that this $93,000 came to be was we take Sun Company's net income and then subtract the amortization, right? Remember the T account, what increases and decreases the equity in subsidiary earnings. So you may want to go back and revisit that. And then Parrot also has this investment in Sun Company. So how do we arrive at the 853? We have our acquisition price. We are going to add our share or I'm sorry, the in this case 100% of net income, then less the amortization and less the dividends. We can see the dividends right here. Just grab the pen. So we can see this is the net income, all right? So that increases our investment, and then the dividends will decrease that investment. We had already calculated the net amortization expense from a previous slide. Okay, so we learned two eliminating entries or consolidation entries last time in chapter 2. Entry S, which was to, the purpose was to eliminate the subsidiaries, the stockholders' equity. And then A, which was to record the adjustments to fair market value for assets and liabilities. Now we're going to be adding 3 more consolidation entries. We have entry I, which is for to eliminate the subsidiary's income. We have entry D to eliminate the subsidiary's dividends. And then we have entry E to record the amortization expense. Okay, so we're starting with entry S, which is what we know and we're familiar with from chapter 2. We say we're going to eliminate the subsidiary's equity. So we're going, in order to zero out this account, we're going, and remember that these are consolidation entries. These entries are only done for the consolidation purposes. These entries are not recorded in parents' financial records, nor are they recorded in Sun Company's financial records. Okay, so keep that in mind. Neither of these two companies is gonna record any of these consolidation entries. These are done outside of their books, outside of their financial records, for the sole purpose of consolidation. So we need to get rid of Sun Company's common stock. So we're going to debit. We're also going to debit additional paid-in capital. So whatever components are there under equity for Sun Company, we are going to either debit or credit, whatever we need to do to get rid of it. So we know common stock usually has a credit balance. So in order to zero this out, we're going to have to debit. Same thing with additional paid-in capital. Note here, I put an arrow here for retained earnings because we are eliminating beginning retained earnings. In chapter 2, we were eliminating ending retained earnings as of December 31st, because the company, the subsidiary, was purchased on the last day of the year. So we didn't have to incorporate any activity for the subsidiary for that whole year because we didn't own it the whole year. We only owned it for on the last day of the reporting year. But in this case, we own it for the whole entire year from January 1st to December 31st. And so we're going to eliminate beginning retained earnings. All right. And then we credit to our investment in Sun Company. Entry A, again, we're looking at the difference, only the difference, okay? Only the difference between book values and fair market values of assets and liabilities. In this case, we have the trademarks were understated, our patented technology was understated, and then our equipment is overstated, okay? Overstated. So that's why we are subtracting equipment here, okay? And so we have, if it's understated, then we have to increase the value of those assets in this case, and therefore in order to increase the value of assets, we're going to debit. So we're debiting. We also had goodwill. We had that figured that out in a previous slide. So we have to add the goodwill there. And then we have equipment. Now, equipment, we are crediting the equipment because the equipment was overstated. So basically our book value was greater than our fair market value, so we need to bring that down to fair value. Therefore, we are crediting the equipment for that $30,000 difference. And then the plug figure goes to investment in Sun Company. Okay, and then we have our new, sorry, this shouldn't be subsequent. Sorry about that. Okay, we have our new entry I. And so entry I is to eliminate the subsidiary's income. So income was a credit, therefore we're going to debit. If it was a loss, then it will be reversed, okay? And so the purpose is to zero out the equity and subsidiary earnings in parent side that the parent had booked in their financial records. And then we're going to also eliminate the dividends. So we credit the dividends and we debit investment in Sun Company. The last entry pertains to our amortization depreciation. So we had that the patented technology. The trademark had indefinite life, so we don't have to worry about the trademark. But the patented technology, we are going to amortize that. The patented technology was understated. So look at here that we are crediting the patented technology because it was understated. So in the previous consolidation entry A, we debited that amount. So we need to kind of chip away that difference that we have debited. We have to, and we do that through amortization. So we're going to credit 13,000 for patented technology. We're debiting amortization expense related to that. And then we have to deal with the equipment, which was overstated, right? So equipment, we are debiting because initially on our entry A, we credit equipment. So again, we have to chip away that difference. So in order to do that, we are going to debit the equipment and then we are crediting depreciation expense, okay? So just pay attention to that when it's over or understated. And then how did we treat it in consolidation entry A? Because that's going to come into play when we come up with consolidation entry E. Okay, so here we have, again, we're using the equity method, and we already talked about how the 93,000 was calculated, how the 853 was calculated, and we have our subsidiary dividends, and we have our subsidiaries net income. Okay, if you're not given these figures, but you're given the amounts from the subsidiary, then you can go ahead and extract it from their financial statements. And then we have our entry S, right? We have eliminated the subsidiary's equity. And we have our entry A, which have stepped up the trademarks to fair market value, the patented technology. And also note the equipment here, it was decreased because it was overstated. And then we are recording our goodwill. We have our entry I, which eliminated the equity in subsidiary earnings, okay? And then we have our entry D, which eliminated the dividends. We're eliminating the beginning retained earnings as well. And then note on entry E, which we have a debit that pertain to the patented technology, and then a credit for the equipment. So at the end of the day, we have a zero balance under consolidation totals for our equity and subsidiary earnings. And we have a zero balance for the investment in Sun Company account under consolidated totals. And then the equity section of the balance sheet mirrors the parent company, okay? So we can say that we check mark and we did this okay. And that concludes our presentation.